Welcome to Talk Tickers. We cut through the earnings call noise to give experienced investors like you the insights you actually need.
And today we're getting into the Skechers first quarter 2025 call.
Yeah, it looked interesting. The big picture seems to be record sales, definitely some good international momentum.
But maybe some headwinds too. Specific markets, margin pressure, things like that.
Exactly. So let's unpack what's really going on behind those headline numbers.
Okay, so first off, those results. Record first quarter sales, $2.41 billion.
That's a solid number. How does it compare year over year?
Up 7.1%. But on a constant currency basis, it's even better, $2.46 billion, which is up 9%.
Okay, 9% constant currency. Decent growth. And earnings per share.
Came in at $1.34 for the quarter.
Right. Now, you mentioned international momentum. Where did that growth really come from?
Yeah, international is huge for them now. It accounts for, believe it or not, 65% of the total business.
65%? Wow.
I know, right? And within that, the EMEA region, Europe, Middle East, Africa was really strong, up 14% year over year.
14% in EMEA. Okay. Yeah. How about closer to home? The Americas.
Also pretty solid. The Americas grew by 8.3% compared to last year.
Good, good. So EMEA and the Americas are driving things. What about the Asia-Pacific region, APAC?
Well, APAC is a bit more mixed. Overall, sales there actually dipped slightly, down 2.6%.
Oh, okay. A decline. That's surprising given the other regions.
It is, but you have to kind of peel back the layers. If you exclude China from that APAC number.
The
rest of the region saw really impressive growth, actually, up 12%.
12% excluding China. So China itself must have been down significantly then.
Exactly. Sales in China fell 16% compared to the prior year, which is, a big swing because they had double-digit growth last year.
Right. So real contrast within Asia.
Yeah.
Okay, let's shift to how they sell. Wholesale versus direct-to-consumer.
Sure. Wholesale overall was up 7.8%. Domestically, here in the U.S., it grew 4.2%.
Okay.
And international wholesale saw even stronger growth at 9.5%.
Makes sense, given the overall international picture. And DTC, their own stores and website.
DTC sales rose 6% globally. Domestically, it was actually quite strong, up 11%. E-commerce was a big driver there.
11% domestic DTC. Nice. International.
So international DTC was up 2.9%. But again, that China effect is in there. If you exclude China, international DTC jumps to 12% growth.
Okay, so that pattern holds strong international performance outside of China. What about physical stores? Are they still expanding?
Oh, yeah. They ended the quarter with 5,318 stores worldwide.
Wow.
And 1,821 of those are company-owned. They actually opened 51 new company-owned spots just in Q1.
Where are they focusing those openings?
Seems like key markets. They mentioned 50 new stores in China, despite the sales dip, and 13 here in the U.S.
Interesting. Okay, so the top line, the sales growth, largely driven by international.
Yeah. Let's talk profitability, margins.
Right, so gross margin landed at 52%. That's actually down a little, about 50 basis points from last year.
Down slightly. Why was that?
They pointed mainly to lower average selling prices. Seems like they had more promotions going on, especially in China.
Promotions hitting the ASPs. Yeah, and also some shift in their customer mix contributed. And then operating margin also saw a dip, down to 11% compared to 13.3% a year ago.
Okay, so sales are up, but it's costing a bit more, relatively speaking, to get those sales. Let's dig into that international strength a bit more. What's the story there?
Well, it really seems to be about this sustained global demand for their whole comfort technology platform. That's their thing.
Right, comfort tech.
Exactly. And management was clear, international markets are their main growth engine going forward.
So they're investing heavily there.
Seems like it. Putting money into the retail store network internationally, making distribution more efficient. And it looks like it's working. I mean, look at that 14% growth in EMEA.
Yeah, that's significant. And the Americas holding strong, too. It suggests the brand itself just resonates globally.
I think so. The comfort message seems pretty universal.
Let's go back to APAC, though. That split between China and the rest is fascinating. Any more color on why China lagged so much?
They mentioned general economic pressures there. Maybe consumer spending is just tighter in China right now.
Could be macro-related then, not necessarily a Skechers-specific issue.
It seems plausible, especially since they grew so strongly last year. It might just be the current environment. But importantly, they said they're still committed to China long-term.
Sticking with it despite the dip. Investing in product, marketing, logistics there.
Yeah, exactly. They see the long-term prize, even with short-term bumps. And that 12% growth in the rest of APAC shows the underlying demand is there in the region.
Okay. And how do the channels, wholesale versus DTC, play into this whole picture?
Well, the domestic wholesale growth being broad-based across kids, men's, women's, that suggests pretty healthy demand from their retail partners here in the U.S.
Right, not just one category carrying the load.
Exactly. And the strong international wholesale growth just mirrors that global appeal again.
And DTC, especially that strong domestic e-commerce number.
Yeah, that 11% domestic DTC growth driven by e-com is crucial. Shows they can connect directly and effectively online. And again, that international DTC growth, 12% ex-China, reinforces the brand pull through their own channels globally.
So looking ahead, strategically, where are they focusing their investments? What are the big priorities?
It seems to be mainly about strengthening the foundations and reaching customers. Number one is expanding distribution centers, US, China, Europe, getting product moved efficiently.
Makes sense with the growth.
Absolutely. The number two is product. Always enhancing the offering, new tech, maybe new categories, keeping things fresh.
Standard retail playbook, but essential.
Totally. And third is growing that direct-to-consumer footprint and capabilities.
Yeah.
More stores, better online experience, more control, potentially better margins down the line.
Right. Now, something always hovering over global companies like Skechers is tariffs. Any talk about that, but particularly U.S.-China?
Oh, yes, they addressed it. Management acknowledged the uncertainty, the potential for tariffs to go up on goods coming from China to the U.S.
So what are they doing? Just watching and waiting?
No, they mentioned strategies they're evaluating. Things like cost sharing with their vendors, maybe trying to optimize sourcing, shift production if needed.
Diversifying away from China a bit.
Potentially. And maybe some price adjustments as a last resort. But they also stressed a key point.
Which was?
That 2/3 of their entire business is outside the U.S. So while U.S. tariffs matter, it doesn't impact the majority of their sales directly.
That's a really important context. Good point. How about the consumer? How are they feeling, according to Skechers?
They sounded a bit cautious, particularly about consumer sentiment and spending power in the U.S. and also in China.
So acknowledging some potential weakness.
Yeah, a degree of caution. But they quickly followed up by saying they still believe the underlying demand for the Skechers brand, for that comfort tech, remains strong.
So even if people pull back a bit, they hope Skechers remains a priority purchase.
That seems to be the feeling, yeah. That their value proposition still resonates even in a tougher climate.
Okay. Inventory, always critical in retail. How are their levels looking?
Inventory was actually up quite a bit year over year, 30%.
30%. That sounds high.
It does, but they had an explanation. They attributed most of it to longer shipping times because of the whole Suez Canal disruption, things taking longer to arrive.
The transit time issue. Okay. Did it improve more recently?
Yes, that's the positive spin. Compared to the prior quarter, Q4, inventory actually decreased by 7.6%. So they're making progress in managing it.
Bringing it down sequentially. Okay.
And they specifically mentioned actively managing inventory levels in China, trying to match the current demand picture there.
Makes sense. And capital spending, where did the money go in Q1?
They spent about $147 million on CapEx.
Okay. Mainly on?
Mostly those distribution center build-outs we talked about, funding the new store openings, and some work on corporate offices. Pretty operational stuff.
Sounds like investing in growth infrastructure.
Exactly. They said they want a strong balance sheet, and they're prioritizing these growth investments, but maybe being a bit more conservative on other capital allocation, given the uncertain climate.
Right. Maybe holding back a bit on buybacks or dividends for now.
They didn't detail specifics, but implied a more measured approach overall, yeah.
Okay, final key point from the call. Guidance. Did they give any outlook for Q2 or the full year?
No, they actually chose not to provide specific revenue or earnings guidance for the near term.
Really? Why not?
They cited the increased macroeconomic uncertainty. Just too many variables right now, I suppose.
Makes forecasting tough.
Very. But they did make an interesting comment, drawing a parallel to a similar situation about 5 years ago where things were also uncertain.
And how did that turn out?
They said they navigated those challenges successfully back then and came out stronger. So the implication is, we've done this before, we can handle it. A bit of a confidence signal despite the lack of hard numbers.
Interesting way to frame it. Okay, that covers the call pretty well. Time for our This Is Not Financial Advices segment. Given everything, that international strength outside China, the caution around the U.S., what's an outrageous but plausible trade idea?
Okay, thinking about that split,
Yeah.
The really strong growth in EMEA and APAC ex-China versus the softness or caution in the U.S. and China.
Right, that clear divergence.
So maybe.
Yeah.
And again, not financial advice. But You could consider looking at footwear players who are heavily exposed to and successfully growing in those specific high-growth international markets, going long those names.
Okay, focusing on that specific geographic strength, what's the other side of the trade?
To balance it, or maybe hedge it, you could consider a short position in footwear companies that are very domestically focused, especially here in the U.S.
Particularly if they're also signaling caution about the U.S. consumer.
Exactly. Companies explicitly citing that uncertainty might be candidates. The sort of outrageous part is betting explicitly on this regional divergence within the same sector, contrasting players based heavily on their geographic footprint.
Playing the map, essentially. Betting against the U.S. consumer relative to certain international ones through footwear stocks.
Kind of, yeah. It's definitely a way to play the themes we heard on the Skechers call, but applying it more broadly. High risk, potentially high reward, definitely plausible based on the current narratives.
Certainly gives us something to chew on. All right, that wraps up our deep dive into the Skechers first quarter 2025 earnings call.
Yeah, we covered the record sales, definitely dug into that international picture, the challenges, the strategies.
So what do you think about Skechers' global plans? Can they keep navigating these choppy waters, especially with tariffs and consumer worries? Let us know your thoughts.
We always like hearing different perspectives.
Absolutely. Thanks for tuning into Talk Tickers. We'll be back soon, digging into another key earnings call.